Welcome back to The Compass. We're recording today's episode on November 19th at about 9:15 a.m. Eastern, so just before market open. I guess with me, as always, is Sam Pelaez, President, CEO, CIO of Olive Resource Capital. My name's Derek Macpherson. I'm the Executive Chairman of Olive. Maybe we did just record the last episode 5 days ago, so there's a little bit of news to talk about, but I think, we're into an interesting time in the market. It's November 19th. We're probably a month away from sort of last meaningful press releases. Volume is going to start to thin out as Christmas, as the Christmas season becomes top of mind. And probably starting as early as next week with U.S. Thanksgiving and Black Friday. Sam, maybe let's start with over the next month or so, which is about a month of kind of real markets left. What should people expect out there from a news flow perspective?
So, this is typically a period where we get a lot of news flow, but kind of light on substance. That's not necessarily a negative thing. I guess what I'm trying to say is we live in these cycles for news flow that correlate well with the capital raising cycles and the periods where most of the companies get to the work, which is winter and summer. The summer results are already well reported. Companies use that typically to raise money in the fall. We're also past the majority of the Q3 quarterly financial reporting. So the news starts getting a little thinner in terms of substance. And it's more like you like to call it like, hey, I'm still here, look at me, type of news releases.
Yeah, I guess the other the add-on to that is there was a lot of money raised in September, October when the gold price was really frothy. And so, that money, those financings have just closed. That money hasn't gone to work yet. And so if you're a CEO of a company like that just all of a sudden got a big balance sheet injection, you're not really going to get any work done in November, December. And so, it's to sate your investors, you're going to want to say, hey, look at me. I have a project still. I'm doing stuff. So, that's kind of what you're going to get. So CEOs have something to talk about going into the Christmas season. It's kind of it's not fluffy news. It's like, oh, our drill program's starting, or we planned it, or we're going to drill here, or we're doing a soil survey, or whatever, right? It's stuff like that. So it's not nothing news, but it is, it's not, drill results.
Yeah, exactly. So I think we've started to see a lot of that over the past few weeks. And that's going to be the theme for the next month or so. We've discussed how the seasonality works for news flow, for investing. This is something we track quite aggressively. And if you look back at our last 2 or 3 episodes, we are of the view that the weakness in the markets would last sort of like halfway through November through to the end of December. That's typical. Then we have the next Fed meeting. I believe it's the first Wednesday in December. So, that's 2 weeks. 2 weeks from now. And, in our view, this typically creates some interesting buying opportunities. Some stories kind of like, they get a little bit soft from the news cycle and give you an opportunity to pick them up or just like top up your position at a good value as you head into Q1, which typically forms the best part of the seasonal period for commodity-related equities. There's a number of reasons for that, and maybe later in the year, as we get closer to that, we'll do an episode on the seasonality of Q1 and Q2 and why do commodities and related equities tend to perform so well in that period. This also correlates with broader market activity, the Christmas rally, etc. So I think for us is right now that the news flow is not extremely intense in the content basis. We take advantage of the opportunity to go back and research some of the names that we like, that we own, and to opportunistically add to certain core positions.
The other thing to keep in mind on a news flow perspective, while the sort of the bigger hard dollar raises sort of all got nailed down through or financings all got kind of nailed down through September, October. The other side of that is that, if you have your favorite Canadian Explorer Co is probably going to raise flow through between now and the end of the year. Talking to our contacts, flow through funds did pretty good on raises, and so I don't think it's unreasonable to think that there's a healthy there's a number of raises coming in that space as well. Traditional flow through, not charity.
Yeah, just as a reminder for the audience that was not in Canada or those who are not very familiar with flow through, you have to deploy the capital that you raise in the same fiscal year. So these funds that raised money in 2025, they have to deploy that money before December 31st, 2025. So you effectively have a race against the clock to allocate that capital through private placements into eligible places or eligible issuers that can take that money. So typically, the month of December, you see a rush of mainly the smaller flow through deals. The bigger ones tend to happen earlier. There's more visibility into those. But yeah, there will be a lot of news flow related to that.
Yeah, and you move down cap as you get later and later in the year, right? The funds try to deploy into larger companies early, and then they work their way down cap. So that's something to watch for. And we could probably do an episode on traditional flow through at some point as well. Just talking about potential impact, maybe late December when the news flow is dried up. He talked a little bit about. I wanted to circle back to something though, because he talked a little bit about seasonality, which I think is interesting. But every year, for the last 15 years, it feels like when you got to this time of year, the seasonal downdraft wasn't just, hey, news flow's light, liquidity's a little bit lighter. The seasonal downdraft was tax loss selling, right? And it felt like it started earlier and earlier every year. It felt like we came out of the Precious Metal Summit, tax loss selling started for the year. I think that I guess for us, I don't see that happening this year. So I don't think you're going to get as much weakness as we typically see sort of in November, December from a lot of these resource companies, simply because, it's pretty rare stock that your resource company isn't up this year.
Pretty much, and exactly. Tax loss selling typically starts after the Denver Gold shows for the primary reason that major U.S. institutions, financial institutions, have an October 31st year end. So obviously they have to sell before October 31st. Typically that continues into the month of November. Almost nobody waits until December 31st to sell for tax losses. Having worked in institutional fund management, you run this. Typically you have software where you can run this. Tax optimization exercises. Shows you which holdings give you the most tax benefit or tax loss accrual for your tax offsetting, and you start selling those first, and et cetera, et cetera. And you're correct. There is no likelihood, or we haven't seen any evidence of tax-related selling in our sector. Obviously, for the obvious reason that the vast majority of issuers are substantially higher than they were in the past few years, when people would have bought them, or even earlier this year. Having said that, we've seen some selling, but I think that's been more related to the seasonality, with volatility reporting and other factors that come into the seasonal aspect, but not necessarily, obviously, to the tax loss in this particular year. Which I guess the consequence of that is we may not see the level of bargains that we sometimes see in the months of November and December, where some real names that have had some issues get completely, taken out, get completely demolished during this season, only to rebound strongly right into the second, third week of January.
Yeah, historically there's a window there around, sort of. I guess it's when it used to be T+3 or now it's T+1 for settlement. It used to be kind of you back up from December 31st, that settlement day, and you could pick up, especially in low liquidity situations where stocks are weak, you could really pick up some nice positions kind of just before Christmas or between Christmas and New Year's. And so, I don't think we're going to see as much of that this year. Everything's kind of in really good shape. It's definitely something that is not the create quite the opportunity it has in the past. But I think kind of kind of as we described, we said this at the beginning of the summer last year or this year, kind of going into the summer, stocks move in this period still, right? And so you could still create, and there's still opportunity here, right? The And so I would definitely, keep your eye out, do your work, because there's less meaningful news. You'll have less meaningful news flow. M&A slows down. Bankers are busy taking their clients out for Christmas, their CEO clients out for Christmas lunches, as opposed to, jamming through M&A deals. So
And there's a very strong seasonal factor that doesn't change regardless of what equities do, and that is the Thanksgiving in the U.S. with all the associated travel and expenses, the Black Friday obsession with purchasing stuff, and the Christmas period, all of which really put a strain in the majority of people's pockets, right? So there's fewer marginal dollars around for you to invest. It wouldn't be unheard of people not contributing to their retirement accounts during the months of November and December. And you could think that this is very marginal in the context of investing, but in our markets, the last marginal dollar sets the price for everyone. So you're taking away some of those dollars, and naturally you will have an impact. For institutions, we have the benefit, and especially like us, where we have permanent capital, we have the ability to take advantage of any, albeit even in small dislocations, temporary dislocations that occur in periods like this. We get the opportunity to be there and participate and, take advantage of these, and this is our Black Friday.
Yeah, that's a way to look at it. If you're a professional junior mining investor, and you're investing your own capital, it's been a lot of lean years. You might be a little bit distracted. Have to buy your significant other a nicer gift this year. That's life as to where you're at, right? Life catches up with junior markets here, and that distraction is what creates opportunity, right? So, and that's what we're looking for, right? We're looking for those stocks that as liquidity dries up, you get dislocations, and so maybe there's an opportunity to pick away at your favorite stock, or maybe there's an opportunity to find that starter position at a little better price. Entry points are important. It's one of the things that we've learned, or I've learned working with you, Sam. But and anytime you have the softness in the market, it creates attractive entry points to get in.
Yeah, it's like what they say about used car salesmen. Not that we want to compare to them, but it's like you make money when you buy the used car and when you sell it to the new owner, right? You have to be very aggressive with that initial purchase price to guarantee yourself, or to give yourself the best chance to succeed in the future. And yeah, just to rehash the point, like typically in my experience, many of our viewers probably have many more years of experience than I do in this department, but this is typically a good period to pick up a few stocks that just will get this temporary dislocations for no reason. Just keep an eye out for them, and Q1 typically is a very rewarding period for the purchases that you make during this time.
Well, I remember a couple of years ago when I did my MBA, and probably back when you did your finance degree as well. There's a whole section in the textbook about about January rallies across, particularly in small caps, and so I think we'll kind of reserve what we expect to see January, February, kind of Q1 ahead of PDAC, for maybe later in the year. This year, it's Christmas season, so we're going to have, with news flow drying up, episodes are going to be a little bit harder to come by, or what we want to talk about is be a little bit harder to come by. I think the next kind of, just a pivot on sort of what we're expecting from news flow to what we've just seen recently in news flow. And it's something that's very, in my mind, is very interesting, that we saw with particularly, it was announced this morning just before market open, but it was Troilus expanding their debt facility on the Troilus mine, as they, expanding the debt facility that they're going out for. And there's a few things with that, but I think there's some specific Troilus things, which is a significant position of ours, that are interesting on that. But then also there are some significant things, to talk about sort of broader in the market that is interesting as well.
You have to caveat that by, Troilus raised $172 million of equity at the beginning of this month, which you would say by any definition should be the complete equity check that's required for the development of the project. Naturally, if they're going for a bigger debt mandate, it's either because they want to have a bigger buffer, because maybe behind the scenes they're optimizing, they're doing some trade-offs in terms of the definitive feasibility study. But either way, I think the signal, and this is I think where you were going, is we are back in a market finally where you can develop your own project. You're not entirely dependent on a takeover to be able to develop the project. Now, there are a few projects that have been developed over the past few years, so this is not the first one. But I think it kind of sends the clear message that we're back in a position where the right people in the right place with the right project can get all the ducks lined up to raise the entire project facility and funding to go ahead by themselves.
But I want to go back to that, maybe the Troilus specific thing, because that there's a change, and I think it's actually really important. So Troilus is really, Troilus had talked about a year ago when we sat with Justin in Colorado, right? He had talked about sort of the debt package being a piece of equity, a small piece of equity, as little as he could, because at that time he was probably sub 100 million market cap at that point, still, or just right around 100 million market cap. So the debt equity piece was harder. He was talking about streaming, which tends to be very expensive money, relatively speaking, and royalties. And then he was talking about a debt piece. Well, the debt piece has sort of been lined up, and that's what they've increased. But oddly enough, in this scenario, the debt, that long-term debt facility, particularly in Troilus' particular case, because it's got the copper and it's got that German guarantee. The cost of capital has come down materially. If you look at, you raise the point that you look at the mines that have been built over the last several years, they've generally been built with exotic private equity structures, right? Orion Mine Finance, they funded a lot of those mines, and they're making 20+% on the money that goes out the door, guaranteed. Forget about equity performance, whether that's in the form of warrants or interest payments or structuring payments or whatever. If you ever look at one of their financing packages, it's where, and so like you look at, a mine that was built in the last little while, Artemis is Blackwater, right? There's a good example. Had to have, in that market, had to have a very creative structure, very similar to Troilus, which is about to be built. Greenstone, which Equinox was building before they were kind of as big as they are now. Very exotic financing structure to get there.
Even Skida.
Right.
Very exotic.
Yeah.
Very complicated, multiple moving parts.
So the interesting part of what's changed is not that, the cost of capital is coming, the $4,100 gold, you would expect that the profitability has gone up, so the cost of capital should come down, right? It's very, that's like finance 101, right? The mine becomes more profitable, the cost of capital should go down. And so that's what I think to me is one of the key takeaways from that Troilus, that expansion of the debt facility of Troilus. They're going to be able to take the streaming piece out, right? Or potentially reduce the streaming piece materially. And that makes it more attractive for a takeout after you're built, right? If you remember, and maybe you don't because you're younger than me, but when Malartic and Detour were built the first time, when they had, kind of single asset companies building them, a Cisco Gold, I want to say.
Gold?
I don't know. An Cisco, the original Cisco. Cisco One. We'll go Cisco One. When a Cisco One was building Malartic, right, there was, it was a very traditional debt equity package. And now we're different time in the market. 2009, 2010, 2011, 2012. Those were a much toppier part of the market. Detour was the same way. Very, very much a traditional, much more traditional financing package. But that's actually what made them attractive to be takeouts, is that they didn't have permanent impairments of the project in the form of royalties. They didn't have, they didn't have these exotic structures they had to work through. It was, both projects were fully financed about 6 times, with equity, with follow-on equity raises. But that's when you're a single asset company and you don't have revenue or don't have cash flow, there are going to be some overruns. And so I think we're back to that market. So you could now, because your cost of capital has come down as a single asset junior, as evidenced by what we see in Troilus, there are companies that are, their stated objective is to get bought out, or the objective they whisper to their investors is, hey, we want to get bought out, but until then we got to proceed like we're going to build it. You look at something like Troilus, they got all the ducks in the row to build it. So if you really want it, you gotta go after it now, right? They're going to get permits here shortly, and because they're one of those focus projects from the Canadian government. So it's going to be it's really it's an interesting shift in capital availability for these companies.
Yeah, but I think everything you said is super interesting. But the read through for the remainder of the industry is what I find interesting. And I want to say something that we for the longest time. I've known a few people who work in this banking syndicates, like multinational, like European institutions, and they actually love investing in mining because they get the type of returns that they don't get in other infrastructure projects. For them, it's the same. They don't care about it, whether it's mining or infrastructure or an airport. It's a big, massive, earth-moving exercise with civil engineering, etc., that has some revenue projections. And they typically get a lot more return on their money in mining. The issue they've always had was not an unwillingness to lend. It was just the difficulty for the mining issuer to put up their equity portion of the deal, to advance the project to the bankable feasibility stage without blowing up the cap structure, and still be in a position where, like Troilus, raise presumably what they've deemed to be enough capital to fund the equity portion of the build. And that's also changed, right? You talk about the banking is coming back and the cost of capital is coming lower, but what's also changed is that now the equity cost of capital has also come lower. And I think it's the blend of these two things that may unlock a few Troiluses or a few companies to go out and decide to do it themselves. And I want to say something before I pass it on to you is, in the previous cycle, we had many companies do this, and some of those are the companies we have today. Like if in the last cycle they hadn't done it, they wouldn't, we wouldn't have all those companies, and we literally have an abyss between the large caps and the developers, right? The mid-tier space is predominantly populated today by companies that actually had the guts in the previous cycle to go out and build something.
Well, I think we were talking about this the other day, but like at some point someone has to build something, right? Like this isn't the way this industry is. It's a depleting industry. You can only drill so much on your existing projects. There's only so many small projects that you can kind of pass around. At some point, someone has to build something. And I think that is critical or important, right? Like at some point, it's the build. Now, you go back to your point on the equity portion, right? When you're like, think about Troilus, right? If you're, even when the stock had started to move, right? You're a 100 million market cap company, 50 million market cap company, or 75 million market cap company when we first started buying, and you're staring down the barrel of a $1 billion build. That is like, okay, you could raise the, let's say it's a 60-40 or 70-30 debt equity split. You can raise the debt portion, as you've kind of alluded to, but the equity portion is 3 times your market cap or 4 times your market cap. It isn't possible. It isn't viable. But if you look at, but then you go, okay, but now that the market's moving and that the equity values have come up, where the cost, I guess the interesting part is, and maybe this is the thing that's changed more so than anything else, is the cost of your equity capital has gone down, but also equity has become available, right? That's the other piece of this that's really important, is that equity nine-figure financings were a year ago were unheard of. It was incredibly rare. Maybe the best of the best companies could go do it. Now it's like, once a week we see a nine-figure financing go up. And I've said this before on the show, but look at syndicates on nine-figure financings. As soon as you get over nine figures, generally speaking, you are outside the resource space. You're outside the traditional pool of resource capital that is writing a check at that moment. And so that is something that, I think everyone's got to be, the generalists are coming, I guess, is the lack of a better description.
I want to say it was about this time a year ago. No, it was 2 years ago around this time. 2 years ago around this time in November, markets were kind of coming off some weak period. And I remember you and I were there. We run into Patti Capo, and Patti Capo said, "Oh, I think this is it. The market's coming back." And literally that day or the next day, Ivanhoe put up the 250. Was it 250 or 500 million?
It was a ridiculous number, but it was a nine-figure financing.
It was 250 or 500 million dollars. Equity, fully placed. Probably Fidelity and three other large institutions in New York at that.
Yeah, but clearly non-resource funds that needed a big position quickly.
But I remember we sat down that day and we were talking about this. It's like, it's been so long since we had a placement like this. This is probably the start. Like, there's very smart people at these big institutions that are not mining focused, but they can smell where the puck's going, and you start at the top. At that point, which was the highest rated global developer? It was Ivanhoe, right? They were still finishing the build at Kakula. That was probably it was certainly the last check in to complete everything. And I remember that was the thought that we had. We said, like, this is the sign that the brother money is now looking into mining, and maybe this is the kickstart of a really nice period. So far, so good. Since then, the markets have been, 2024 was more gradual, 2025 has been explosive, but since Q4 2023, we've pretty much been on an uptrend, a very solid uptrend for gold predominantly, but also for copper.
Yeah, that was a very interesting, that was a moment. And then there was actually, if I remember correctly, in January of 2024 that year, there were a few follow-on nine-figure financings. I can't remember. I know First Quantum was one of them, but that was a bit of a bailout on the Panama. But yeah, there were a couple of big financings in that period. And I think, and then and we've seen those continue, right? And I think that's, but I guess back to that point, the generalists are coming, and they're coming in more and more aggressively, and we're seeing that money flow into. Now we're seeing that money flow down cap, which is, Troilus is down cap, right? This isn't it's not a producer, it's a developer, and they're in the process of, as they say, when you're a developer, you threaten to build it till someone wants it more. Well, they're going to be putting shovels in the ground soon at the rate they're threatening to build it. And so I think that's but I think the fact that they can do it, and they can do it at a reasonable cost of capital, I think is actually a critical point, and is a really, really good sign for the industry as a whole, because at some point someone needs to build something, and it looks like that's starting to happen.
Right. Have we missed anything?
Oh, we probably missed tons of stuff, but there's lots going on in the market. As probably viewers can see, I'm not sitting at my desk at home. I'm at the Benchmark conference in LA this week, and so we'll give a kind of, I'm only half a day in, so we'll give a fuller rundown next week of what we're seeing. So maybe a little bit off the beaten path for us, away from sort of copper and gold where we've been focused. There's lots going on out there in the space. A few minor news items that we probably need to talk more about. Tether's getting more and more involved in the royalty space. So I just think there's lots going on, even though the news flow is slow. So we'll pick one of those topics up next week and go for there. But looking forward to chatting with you guys early next week.